this video, we'll break down one of the most powerful formations in trading, imbalance. You'll learn how major market participants leave noticeable traces on the chart and how to interpret them correctly so you can use them to enter high-quality trades with strong potential. We'll also go over a step-by-step sequence of actions and setups that you can apply to any market, crypto, forex, stock, or commodities. The logic of price formation is the same across these markets, and you'll see this for yourself in backtests using the strategies shown. Let's start with the basics. What is imbalance? Graphically, it is a gap between the wicks of 3 consecutive candles, regardless of their color. In a bullish scenario, the upper wick of the first candle does not overlap with the lower wick of the third candle. The area that forms between them indicates that supply and demand have fallen out of balance, in particular that buying pressure has suddenly and significantly exceeded selling pressure. This is what led to the rapid upward price movement and the formation of a gap between the high of the first candle and the low of the third candle. In this area, either there were no trades at all or they occurred in minimal volume. The price simply jumped over several levels, leaving no time for proper interaction between buyers and sellers. The main reason for the emergence of such imbalances is the high activity of institutional players. Large banks and funds place such big buy orders that the market cannot react to them efficiently in time. As a result, there is a sharp price jump upward, reflecting the market's attempt to absorb the suddenly appearing volume. Such areas become key for further analysis, since the price will tend to return to them to restore balance, offering a fair price for both sides of the market. When you open a chart, searching for imbalances should be one of your first steps because they directly reflect the actions of large capital, which you need to follow when opening your own positions. To avoid confusion as we continue with the video, let's briefly go over the main terms. Imbalance is usually denoted by the abbreviation FVG, which stands for fair value gap. To specify the type of imbalance, the abbreviations BS and BS are used. BS stands for bullish imbalance and BS stands for bearish. Imbalance is also often referred to as price inefficiency. Effective pricing looks like this. We don't see any gaps. The price offered is fair and balanced for both buyers and sellers. All these terms describe the same phenomenon, a price gap that arises due to an imbalance between supply and demand. If you want to see the application of everything I talk about in these videos, but in real time, subscribe to my Telegram channel. The QR code is on the screen and the link is in the description. So what does an imbalance represent from a pricing perspective? First of all, it's a magnet for the price. The market will tend to return to this area in order to balance it. Secondly, an imbalance represents a strong support zone. After reaching it, the price is expected to show a strong reaction and continue developing within the current upward trend. For us, this is a key opportunity to consider a long position. Now let's switch to the 15-minute time frame. Here, the 15-minute imbalance within the hourly one is marked. This is done to narrow down the potential area of interest where we can expect a price reaction. Such a situation is typical. Every inefficiency is reflected on the lower time frames as well, and finding the spot where they overlap allows for more accurate predictions of possible price reversals. We did the same thing with the next imbalance. This internal imbalance now acts both as a magnet for the price and as a support zone from which it makes sense to consider long positions. I want to clarify right away. We mark this zone in this particular way because the range between this swing and this low is already balanced and it no longer holds any interest for the price. The next bullish imbalance is highlighted in gray. We cannot use it as a support zone because the hourly imbalance below it takes higher priority for the price. As you know, higher time frames are more important than lower ones. This rule applies here as well. If you look at the current price action, starting from this candle, you can see active selling by major market participants. The selling pressure significantly exceeds the buying pressure, which confirms the imbalance that we can mark from this X to this low. Its appearance is an early and strong sign of the beginning of a downward order flow. The price will seek to balance out the resulting inefficiency before continuing to fall into the area of the 15-minute bullish imbalance, after which the upward trend will resume. Let's look at how it develops. The bearish imbalance is rebalanced, and we see an aggressive drop into the zone of the hourly and 15-minute imbalances. We linger there for a bit, filling all previously unfilled orders, after which the upward trend continues. The examples shown here illustrate universal principles of price movement that apply to all markets and time frames. Once you master them, you'll be able to predict most future movements with a high degree of probability. How do you correctly identify an imbalance within another imbalance? Here is a time frame grid that you can use depending on the market situation. For example, to refine a monthly imbalance, you can use the weekly and daily timeframes. Going lower than that would be impractical, because in that case the approach would lose much of its effectiveness. And this is how refining a monthly imbalance looks on the daily time frame. We not only narrow down our potential area of interest, but also significantly increase the accuracy of our forecasts, minimizing risks and increasing the chances of successful trades. This allows us to focus only on key levels where a strong price reaction is most likely. And here we do the same thing, but now we use the daily time frame as the main one and the hourly time frame for refinement. The principle of operation and implementation remains absolutely the same. Now let's discuss how to choose the most suitable imbalances for trading. The chart shows a typical situation. During the price decline, two bearish imbalances were formed. At first glance, they may seem equivalent, but to make the right choice, it is important to consider their position in the market context. To determine which of these imbalances has greater potential to play out, we need to refer to the concept of premium and discount zones. To do this, we draw a Fibonacci retracement from the high where the decline started to the low where the correction begins. The 0.5 value marks the level where the asset is trading at its fair value. This is a kind of balance line that divides the market into two zones, premium above it and discount below it. The premium zone is an area where the asset is trading at an inflated price with a markup. In this zone, major market participants aiming to maximize profits fill the bulk of their sell orders before the asset is further discounted. Therefore, the second imbalance, which is located above the 0.5 level, is supported by the active actions of smart money and has a higher potential for being realized compared to the first imbalance in the discount zone. Additionally, it is important to remember that the market always strives for equilibrium, the 0.5 level, since this is the point where supply and demand are balanced. Therefore, ignoring bearish zones of interest in a discount market will not only reduce your risks, but also increase the overall effectiveness of your trading over the long term, allowing you to focus on more promising trades. In a bullish scenario, we do the same thing, but now we are interested in buying, and it is most advantageous to make purchases in a discount market. The first imbalance along the path of the corrective movement is located in the premium market, so we ignore it, understanding that the likelihood of it being successfully worked out is extremely low. The second imbalance is located in both zones, both in the premium and in the discount. This situation occurs quite often, and the most effective approach to dealing with such inefficiencies is to use only the part that is below the 0.5 level. This will be our first area of interest for considering a long position. The next imbalance is located deep in the discount market, and we will use it to consider a long position, provided that the price does not reverse from our first area of interest. And this is how the development of the upward trend looked. To sum up regarding premium and discount zones, I want to note that this is a conservative approach that will significantly increase your win rate and improve your average risk-to-reward ratio. However, you should keep in mind that sometimes you will miss certain opportunities when the price moves too aggressively and does not return to the fair value level during a correction. Despite this drawback, such an approach provides more stable and predictable results over the long run. Now let's move on to the next part of this video, the creation of a simple and effective trading setup based on the imbalance formation. This table shows simplified options for combining time frames that we can use when analyzing any chart. For example, if we start our analysis with the daily time frame, the main work should be done on it. We determine the market direction, key liquidity pools, and imbalances that have not yet been filled. Next, we move to a lower time frame, in our case the hourly chart. On it, we can refine the imbalance from the daily time frame, find a reversal pattern, and enter a trade. Such a simple action plan will allow you to find frequent and high probability setups based on the logic of market movements and the actions of major market participants. Now we will go through each step in detail, consider all the necessary factors before opening a trade, entry options based on imbalance, as well as the correct placement of stop loss and setting of targets. The first and perhaps most important step is determining the market direction on the higher time frame. To do this, we need to analyze the market structure, taking into account unfilled imbalances and untouched liquidity pools. Here, an uptrend is shown consisting of 5 candlestick swings. The key elements we are interested in at this stage are the most recent higher high and higher low. They form a trading range that marks the boundaries within which the price is currently correcting. A downward trend that forms within an uptrend is an event you will encounter extremely often. Smart money artificially creates it when they need to attract as much new liquidity to the market as possible. Above each high, new buy orders accumulate, and below each low, especially during corrections, new sell orders are concentrated and then removed. These are used by smart money to reaccumulate their long positions with the aim of further marking up the asset. Support of the trend by major market participants indicates its strength and relevance. Therefore, with the following steps, we need to determine when the correction cycle will end and what our targets for future growth will be. Our second step will be to identify the key levels for the price. In our case, these are equal highs and lows. These levels are always artificially created to attract new, less informed money to the market, which is then used by smart capital to achieve their own goals. We should not view them from the perspective of traditional technical analysis. These are not support and resistance levels, but zones of critical liquidity concentration, which will inevitably be broken through because that is exactly why they are created. Liquidity is the driving force behind any price movement. The market cyclically moves from one liquidity zone to another, creating recurring patterns that appear in any market and on any time frame. To understand these cycles, we need to study the concept of internal and external liquidity. Becoming aware of this will give you a clear understanding of how and why price moves. And this is extremely necessary knowledge for stable and profitable trading. The diagram shows a typical uptrend. Its structural elements indicate the levels where external liquidity accumulates. Internal liquidity refers to all the swings that are within the range between this higher low and this higher high. The pattern of development for any uptrend is extremely simple. First of all, external buy-side liquidity is taken out and a new higher high is formed. Such an event leads to a reduction in available funds on the market and creates a need to revalue the assets in the opposite direction. During a correction, two things always happen. Internal sell-side liquidity pools are taken out and previously formed price inefficiencies are rebalanced. In this way, smart money encourages traders to open new positions, filling the market with the liquidity they desperately need to reaccumulate their positions and continue the original movement. The cycle ends with the price moving to a new level of external buy-side liquidity, after which everything repeats again according to the same principle. This reflects the continuous dynamics of an asset's movement based on changes in the amount of liquidity in the market. Remember, after external liquidity is taken out, the price will tend to move toward internal liquidity and vice versa. And here is the external and internal liquidity in our example. Relying on the standard cycle, we can expect the price to move toward taking out internal sell-side liquidity, followed by a reversal with the asset being revalued toward external buy-side liquidity. To confirm and refine our assumptions, a third step must be added to the analysis. This step involves identifying available imbalances, which will become our zones of interest for opening a position. The first imbalance you see includes the key factors that reinforce it. It is located in the discount zone, and above it are internal sell-side liquidity pools. Thus, smart money has prepared the ground for active buying at the best prices before the trend continues. The second imbalance is already bearish, and it has formed within the local range where the price is currently trading. Its appearance indicates that smart money intends to push the price even lower, which we can use to open short-term short positions. Our first imbalance will serve as the main target. The third imbalance is located above the external buy-side liquidity zone and represents the first problematic area on the path of upward movement. We can expect a price reaction from this level and at least the start of a correction, during which internal sell-side liquidity pools will be taken out. Thus, with just 3 steps, we have created a highly probable plan for potential price movements that we can work with in the coming days. First, we expect a rebalancing of the bearish imbalance and look for opportunities to open a short position. Then, within the bullish imbalance, we wait for a reversal and open long positions with the goal of updating the last higher high and reaching the area of the third imbalance, from which we will again consider short positions. Now we will switch to a lower time frame, and I will show you what we should do in our zones of interest to maximize our chances of success. Here is our chart, the 15-minute time frame. And the first thing you need to do is to refine the previously marked imbalances. Thus, our zones of interest are significantly narrowed down, from which we will expect a price reaction. Based on this, we can adjust the previously created plan on the higher time frame. The search for a local short position will take place when the 15-minute imbalance zone is reached. With a high probability, it is precisely in this zone that a reversal will occur and the price will continue to fall. The target for the future evaluation of the asset will be the beginning of the bullish 15-minute imbalance. When it is rebalanced, we should not only close the short position, but also start looking for opportunities to open a long position with the potential to rise toward the last structural higher high and the first problematic area above it. After our zone of interest is reached, even in the manner shown on the chart, we look for confirmation that a decline will indeed begin from it. Confirmation includes 3 key factors. The removal of buy-side liquidity, followed by a sharp drop that is accompanied by a break in structure. And finally, the most important thing is the formation of a new bearish imbalance which signals the beginning of a downward order flow. Even if a break in structure does not occur, a bearish imbalance will serve as an early sign of a reversal and will become a zone of interest for opening a short position. In this case, the concept of premium and discount zones is not relevant, so we place a limit short order at the beginning of the imbalance. We set a conservative stop loss above the last high from which the decline began and set the take profit at the start of the 15-minute bullish imbalance. Partial profit taking is possible when internal sell-side liquidity is updated, but this is not mandatory. The trade yields a risk-to-reward ratio of 1:6. This is an excellent result. If you maintain a consistent risk-to-reward ratio of 1:6 or higher in your trading, you will only need a win rate of at least 15% to remain profitable. That is, out of 100 trades, you only need to have 15 successful ones. Just keep that in mind. As you can see, the price was perfectly delivered from one institutional zone of interest to another, and our trade closed within 3 hours. Thus, our setup, based on just 3 steps of analysis on the higher and lower time frames, demonstrates clarity and efficiency in execution. Now you can see how these simple yet powerful steps can lead to precise and successful trading decisions. We're back on the 4-hour time frame, and now we'll look at 2 opportunities to open a long position. One will be aggressive and the other conservative. The first option is quite simple. We set a limit order at the start of the 15-minute imbalance and place the stop loss based on the 4-hour imbalance. Here is the low of its second candle. The targets will be the previous higher high and the start of the bearish imbalance above it. This is an aggressive approach since we are not waiting for confirmation of a reversal from our zone of interest. If you believe there are enough factors for growth, then such a risk is often justified. The second, more conservative option involves waiting for a local structure break so that you can look for opportunities to open a long position during the subsequent correction. Here's what it looks like. We have had a minor boost and a correction is potentially beginning. Its main target will be the bullish order book in the discount market. Simply because this is the only support zone that has formed within our current range, we have nothing else to choose from. Before the order block, we can notice internal semi-liquidities for sale. This is a classic situation that strengthens the support zone and indicates that smart money is preparing the ground for active buying before the asset continues to grow. As smart money traders, we should follow the major market participants, so within the order book, it will be interesting for us to consider our positions on a lower time frame. Switching to the 15-minute time frame immediately gives us the opportunity to refine the order book. Within it, a slight inefficiency can be observed, and reaching this area will serve as a signal to look for reversal patterns and subsequently enter a long position. It is important to note that every order book on lower time frames should include imbalances or other institutional zones of interest, as these are precisely what act as triggers for price movement. Here, we see a successful test of the order book and a confirmed bullish setup, which includes a local liquidity sweep on the sell side, a break of structure, and the formation of a new zone of interest, from which we will consider entering a position. A limit order to go long will be placed at the beginning of the imbalance, and there are 2 options for the stop loss. The aggressive stop loss will be placed below the nearest low, while the conservative one will be set a bit lower beyond the swing, where the setup loses its relevance. The choice between them depends on your trading style and the desired risk-to-reward ratio for the trade. Targets are set at the levels we identified on the higher time frame, but if you prefer to trade locally, you can limit yourself to a single take profit at the last high from which the correction began. And here is the further development and execution of our trade with a risk-to-reward ratio of 1:9. And here, the next trade is already being shown, an aggressive one that could have been considered using the same template we discussed in this lesson. For all the examples you saw, I shared my expectations and trades in my public Telegram channel and showed how they played out. That's where we'll wrap things up. Don't forget to run backtests on a market simulator to hone your skills and make sure your chosen approach is reliable. This will not only help you gain more confidence in your trades, but also significantly improve your results.